Hello all. Do you really think that a lower NAV or a lower share price is an attractive proposition before taking your investment decision? Let's find out. Life is all about choices. While some choices are easier to make, others are not. For instance, if you have to choose between the same category schemes of different mutual funds, which would you choose? The concept of NAV or the net asset value of a mutual fund is probably one of the most misunderstood one in the investment universe. Given a choice, if you are to choose between the same category of different mutual fund schemes, which would you choose? Mistakenly, investor would prefer the one which come with a low NAV. Why? Because lower the NAV, the more the units you get, isn't it? Ideally, most would say the one with a lower NAV would work better. Why is this NAV debate so important when it comes to investing in mutual funds? It is quite common for investor to believe that a fund with a net asset value of rupees 22 is better than a fund with a net asset value of rupees 85. As with stocks, mutual fund investor believes that the best mutual fund are those which are with lower NAVs. Now, if you look at the NAV history of funds, you will see that the best performing funds are not necessarily those with the lower NAVs. You invest in mutual funds for the quality of the portfolio and the quality of the fund management. Let's understand what is NAV is all about. In simple terms, NAV is the price of a fund you are invested in. If you bought a fund at a NAV of rupees 10 and it is up to rupees 14 in 2 years, then it is a return of 40% over 2 years. NAV is slightly different from a stock price because stock price represents the present and the future prospect of the company. That is why price to equity ratio are important in stocks. We will also discuss myth around lower stock price shortly after discussing this mutual fund NAV. In the case of mutual funds, however, there is no question of factoring in the future. The NAV is the book value of the fund scheme that you are holding. It is the market value of all the stocks in your equity fund minus the cost and divided by the number of units. It can be expressed like that. Here, the total expense ratio is the total cost of the fund that has to operationally incur, including distribution expense, administrative expense, registrar expense, statutory and marketing expense. So let's understand why preferring the low NAV over high NAV can be an erroneous strategy. Here are the key risks of focusing on low NAV. Number 1 point. The first myth is that a fund with a lower NAV means that you get allotted more units. Frankly, that hardly makes a difference. Whether you hold 1000 units of rupees 12 or 100 units of rupees 120 NAV, it is one and the same. What you have missed out is that the second fund has grown 20% from 100 to 120, whereas the NAV of the first fund may have grown less than 10% from 11 to 12. The outperformance of the second fund may either be due to better fund management or due to the assumption of higher risk. That should be your focus. By focusing on low NAV, you will miss the story. Number 2. Will a lower NAV make a fund more nimble-footed? Say there are two funds with a similar investment pattern. The only difference is that the second fund has issued a higher number of units. That means that the second fund will have a lower NAV per unit. Does it make it more attractive than the first fund? Not if the portfolio remains the same. From that point of view, their performances will depend on how the corpus in the portfolio are managed. It is therefore irrelevant how high or low the NAV of the fund is. The amount of your investment decisions remaining unchanged. Between two funds with identical portfolios, a low NAV would mean a higher number of units held and consequently a high NAV would mean a lower number of units held. But under both circumstances, the product of the number of units and the applicable NAV, your investment value is the same. It is the stock of the portfolio that determines the return of the fund and the NAV is immaterial. Number 3. Now we came to a very popular dividend myth. 20% dividend of a fund with a face value of 100 is more in rupee terms than a 20% dividend on a fund with a face value of rupees 10. That is again a myth. Dividend reduces fund value and this is reflected in the lower NAV. Whether rupees 100 becomes 80 or rupees 10 become 8, it is one and the same. Don't get caught in that some value myth. Fourth point and finally, it is better to buy a new fund offer NFO at a price of rupees 10. The NFO, the new fund offer, as the name suggests, is the new launch of a fund. The fund would collect money from the investor first and invest it on their behalf later. That is why it is offering a unit of rupees 10. An existing fund on the other may already have made investment. Depending on its performance, NAV would be higher or lower than 10. Avoiding a scheme with a higher NAV is wrong because you are actually penalizing a fund with good performance in past. The bottom line is that your NAV level really does not matter. What matters is the composition of your portfolio and how it is managed between the contour of risk and return. Now let's assume both the scheme invest in same category with an identical portfolio. Then it would really matter whether you invest in a low NAV or high NAV. Let us find out. Now let me explain clearly. It is true that low NAV would give you more units, or higher NAV would put lesser number of units in your hand. In both the cases, if the identical fund appreciate in same percentage, even if the NAV differs was rupees 100 by 1000 or even 10,000 on a day of investment, your absolute returns would remain the same in both the case. Now find out an example which I have shown you here. In case 1, SDFC index fund we have taken. Index fund Sensex plan is a fund that invests in the 30 stock that comprise the BSE Sensex in the same proportion. Its primary objective is to generate return that replicate with the performance of the Sensex. On 26 November 2015, its NAV was 224.48. Let's assume you invested 10,000 in this fund. Accordingly, you would have received 44.55 units. 4 years down the line, as on November 22, 2019, the NAV of the fund is 359.15. Thus, your investment is now valued at 15,998.86. In case 2, however, your friend feels that 224 NAV is a pretty high, when an identical fund like Reliance Index Fund Sensex plan is available at an NAV of 12.887. This fund to invest in the same proportion of 30 stock comprising of BSE index. So you prefer to invest 10,000 rupees with NAV of 12.884 and receive 775 units. 4 years later, on November 22, the fund NAV was 19.86, which work out, so its investment value work out to be 15,410. If you compare both the cases, you will see that you and your friend got nearly the same return despite the fact that the NAV of SDFC was 18 times more than his Reliance NAV. This clearly goes on to prove that it is a misconception that a mutual fund with a lower NAV is cheaper and hence better than a fund with a higher NAV. Therefore, it is safe to conclude that it's not the wisest thing to base your investment decision on NAV of a particular fund. Comparing NAV is not the best parameter because it doesn't guarantee the future prospect of any mutual fund schemes. If two funds have the same portfolio, they will deliver the same return, no matter what their NAV may be. So while investing in mutual fund, look at the fund manager experience, as he is the one who is going to manage your fund, portfolio composition and risk parameter before taking a call. Merely investing just by lower NAV will be completely erroneous. Now look from the share perspective. Do low share price means it attractive? Let's find out. There is a common saying, don't judge a book by its cover. An equally valid truism for the investor could be, don't judge a stock by its share price. Many people incorrectly assume that a stock with a low price is cheap while another one with a heftier price is expensive. In fact, a stock price says little about the stock value. Even more important, it says nothing at all about whether that stock is headed higher or lower. Let us understand stock price versus stock value. The cheapest stocks, also a stock that has dropped from 40 to 4 may well be end up 0, while a stock that goes from 10 to 12 or 20 might double again to 40. Looking at the stock share price is only useful when taking many other factors into accounts. Now I am going to share with you key points where you will be able to find out whether a stock with a low price is really worth buying or not. A stock price indicates its current value to buyers and sellers. The stock intrinsic value may be higher or lower. The goal of the stock investor is to identify stocks that are currently undervalued by the market. The goal is to identify stocks that are undervalued. That is, their price do not reflect their true value. What price tells you actually? Let's find out. Most people believe a stock value is indicated by its price. That's only true to a certain extent. There is a big difference between the two. The stock price only tells you a company's current value or its market value. So, price represents how much the stock trades at, or the price agreed upon by a buyer and a seller. If there are more buyer than seller, the stock price will climb. If there are more seller than buyer, the stock price will low. On the other hand, the intrinsic value is the company's actual worth in rupees. This includes both tangible and intangible factors, including the insights of the fundamental analysis. Now let's find out when price actually matters. Companies raise cash by issuing equity or debts. The weighted average cost of capital, that is WACC, is a weighted average of a company's cost of debt and cost of equity. A stock is cheap and expensive only in relation to its potential for growth or lack of it. If a company's share price plummets, its cost of equity rises, also causing its WACC to rise. A dramatic spike in the cost of capital can cause a business to shut its doors, especially capital-dependent business such as bank. Hence, this problem should always be in the mind of investor following a sharp stock decline. Don't jump on buying solely if the stock price are falling. Investors often make the mistake of looking only at the stock price because it's the most visible number in the financial press. For example, if a company has 100 billion market capitalization and has 100 billion shares, while a company B has a 1 billion market capitalization, 100 million shares, both the companies will have a share price of 10. But the company is worth 100 times more than the company B. A stock with a 100 share price may seem very expensive to some retail investor. They might think that 5 rupee stock has a better chance of doubling than a 100 rupee stock. But the 5 rupee stock might be considerably overvalued and the 100 rupees could be undervalued. The opposite could also true as well. But the stock price alone is no sign of value. So market capitalization is a clearer indication of how a company is valued and gives a better idea of the stock value. I'm going to tell you brief about how you can understand market capitalization and share price. Stocks are divided into shares to provide clearly distinguishable units of a company. Investors then buy a portion of the company corresponding to the portion of the total share. The actual number of shares outstanding for publicly listed companies varies widely. One way in which a company controls the number of available shares and how investors feel about their shares is through stock splits. Stock prices can have a psychological impact and companies will sometimes cater to investor psychology through stock splits. How are stock splits work? A 2-for-1 split means that the company will double the number of shares that each of its current shareholder owns by simply dividing the current price of its shares in half. The 2 new shares will be exactly equal to 1 old share. That is why market capitalization is important. The company's market cap will not change due to this split. If a 3000 investment means a 0.001% ownership in the company before the split, it will mean the same afterward. Now let's take an example. Berkshire Hathaway versus Microsoft. In 1980, the share of a Berkshire Hathaway was sold for at $340. The triple-digit share price may have made many investors think twice. As of April 1st, 2020, Berkshire Class A shares are worth at $261,250 each. The stock rose to this height because the Buffett created shareholders' value. At that share price per share, would you consider the stock expensive? The answer to that question, as always, does not depend on the dollar price of the share. Another example of a stock that has generated exceptional shareholder value is Microsoft. The company share has split at least 9 times in its initial public offering in March 1986. Microsoft closed $27.75 on the first day of trading. It was valued $152.11 per share as of April 2020. That seems like a decent return more than 3 decades later, but when all the splits are accounted for, a 27.75 investment in it would be worth significantly more today. And because the stock split, each share now also represents a much smaller piece of the company. Microsoft and Berkshire both produced stellar return for investors over the periods in last 30 years. But the former split several times, but the latter did not. Does that make one expensive than the other now? No. If either should be considered expensive or cheap, it should be based on underlying factor, not the share price. A stock could be available at a price lower than its peer for a variety of reasons. Don't be tempted by this. It is important to know about the growth prospect of the company. To identify a stock, you should compare its price with its fundamental factor and buy when you believe you are getting great value for the company. Let's look out certain points and not price, as price is not an actual indicator of a stock price. Company stock price is affected by its financial health. Stocks that perform well typically have good solid earning and strong financial statement. Any good news about the company will affect its stock price. It may be a positive earning report, an announcement of a new product, or a plan to expand to new area. If the news is negative, it tends to have a downward effect on the share price. The most commonly used yardstick to determine the price to book value and price to earning. If these multiples are low, buy the stock. However, this principle may not always work to your advantage. Often a stock can appear more reasonable and attractive than its peer because these ratios are low. For instance, a stock may be trading at a single digit PE multiple while the market trades at over 20 times on a trailing basis. Or it could be quoting below its book value. However, this is not always a good reason to invest in the stock. You need to examine various other factors as said earlier to determine whether it's of a good value. Firstly, you need to study the PV V and P over a long period of time, that is for 3 years. This is because 1 year performance can be accidental or stage managed. Also, it is not enough for the price based parameters to be low. It is essential that the building blocks which makes these ratios are improving. So the sales, operating profit, EBITDA margin, net profit, return on net worth should be on the rise. If it has no growth or low growth prospect will quote a discount to its peers of the market. A company can register a low growth for many reasons. The industry itself could be stagnating, or the product can be in the process of being phased out. A typewriter manufacturing company went down and the product became obsolete with the advent of personal computer in 1990s. Another important reason for the discounted price can be quality of management. This is a broad term which covers all management style from a dishonest one to one that is honest, but the lack of vision and drive to growth. In high growth industries, if the management quality is not good, the stock valuation will be below that of its peer. A company that encapsulates all of this point is MTNL. In 2000, the telecom firm stock was available at a price of 390 and the investor bought it because they considered the price cheap. However, MTNL prospect have been declining and 10 years on the stock price has dropped to about 65. Over the same period, the Sensex has moved from 6,000 to 21,000 level. I'm talking about in 2011's time. MTNL was licensed to operate in two of the most dense landline market, Delhi and Mumbai. However, the growth in the industry in these two cities are primarily spurred by mobile phones. The company was operating in a segment and the market where the growth prospect was very low. As an investor in stock, you want to make the best return on your investment by buying or selling at the right time. You may hear financial media pundits saying stocks or the share of a company are currently cheap or expensive, but not really understand what they mean by those relative terms. You might often hear this terminology in connection with a story or whether now would be a good or bad time to buy or sell a specific stock. Now let's understand what is the meaning of an expensive stock. When experts call a stock expensive, they are often referring to the stock price to earning ratio. These metrics tell you how much an investor is willing to pay in terms of stock price for the earnings a company produces. In general, the higher the P, the more expensive a stock market value is relative to its value based on its financial performances. You can compute a stock P by taking the current price per share and dividing it with the earning per share. So a P ratio is equal to price per share divided by the earning per share. For example, a company with 2 EPS and a current stock price of say 20 would have a P ratio of 10. It tells you that the investor is willing to pay 10 times EPS for the stock. EPS stands for earning per share. If a company earning remain constant but the price per share continue to rise, it drives the PE higher. At some time, the analyst will deem that the stock is expensive, which often precedes a recommendation to sell. Now, what's cheap? Conversely, the stock PE falls, it becomes cheap. When a stock considered cheap, this may turn it to be a buy candidate. Of course, the stock P is just one tool of evaluating stocks. The cheap versus expensive analysis does not tell you an important details. Investors need to know at what P the stock is cheap and expensive. For individual stocks, start looking at the industry peers to compare their P. If other company in the stocks sector show higher P, then your candidate may indeed achieve. But if the sector has lower P, your stock may be expensive. So you understand that why low stock prices and NAV doesn't make a it attractive to buy, and also some factors you should look while choosing your investments. Drop me any query in the comment section below or in the link provided. I will personally get back to you on that. Always seek a professional help by investing. An equity investment is a long-term investment. Always keep that in mind. Do subscribe to my channel for more content. Happy investing. Thanks.